Good afternoon and welcome to HYROX's weekly webinar where we're going to talk about what we see happening in the global economy and financial markets and the world of wealth management, how all of this impacts our decisions on the best courses of action for our and your investment strategies. Now, we invest our own money in the exact same models as our clients, and we think that that is really important because we are, in fact, eating our own cooking. Our discretionary management enables us to make quick decisions and execute them immediately for all of our clients simultaneously, which is especially important in volatile markets as we take advantage of opportunities that avail themselves to us. I'm Scott Tomlinson, and I'm joined by my partner and colleague Paul Tepsich, the founder of HYROX, who, by the way, has done some wonderful bottom-up research for our tactical model and has been quite astute with a few of his value picks so far this year, continuing to add value to our models and portfolios while at the same time reducing our exposure to risk. Our financial planner and wealth forecast specialist, Bianca Tomlinson, is also on the call. We will have a question and answer period at the end of the call, so if anyone on the call has a question about any aspect of wealth management, we do invite you to feel free to ask questions. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. If you happen to be a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the Private Client Division tab. Well, as we do each week, let's recap our themes for 2016 before we get started on what happened since we last talked. And as everybody knows by now, our overall overriding theme for 2016 is that financial markets will remain volatile. Volatility bounced back a week and a half ago as uncertainty levels rose. The U.S. economy contributes approximately 20% of the global economy, and the risk of a recession in the U.S. is high and rising, we believe. Low inflation and deflationary pressures continue on a global scale despite the efforts of central banks to mitigate them. An extraordinarily stimulative central bank monetary policy on its own has not succeeded in reigniting economic growth, and now central banks are revisiting their options. First, Brexit and the rise of populism in developed nations, and now with the U.S. presidential election, there was a concerted pushback against globalization. Add in terrorism, and the sum of all of it is having an impact on the consumer, business, and investor psychology. Bond markets are in a state of flux as investors try to ascertain some direction, but that will not be likely until we hear from the Bank of Japan tonight and the U.S. Federal Reserve tomorrow. Equity market prices, which had been comforted by central bank monetary policy stimulus, showed their vulnerability a couple of weeks ago. September is historically a volatile month for stocks. We are in a time when the risk-free rate of return is dangerously close to zero, and I did hear a commentator suggest that it might even be negative, which means that to try to get higher returns, investors have been taking on more risk. We think that this makes for a precarious situation for investing, and that caution should continue to be the order of the day. Okay, so let's have a look at what has been driving markets over the last week. As we had anticipated, volatility has returned. We do not think that it is going away anytime soon. And this is how volatility looks relative to recessions, past recessions in the U.S. It certainly gets elevated, but that is probably no surprise. With higher uncertainty comes more fear and volatility. The Fear and Greed Index now at a neutral level as we wait for, as I said earlier, those central bank monetary policy meetings that are going on as we speak. Well, this is what we had been suggesting would have happened based on past experience, and this is what has happened. We think there might be more fear to come. And since our last webinar, our benchmark World Equity Index is better by 1% and up by just a little over 4.25% on the year. The best performer on the week was the UK FTSE 100 index, and the worst performer was Japan's Nikkei 225 index. The TSX has been the best performing country index in the developed world this year, and China China's Shanghai Composite has been the worst performing index in the world this year. The broad and diversified benchmark equity index, upon which we gauge the performance of our global equity model, performance covers close to 2,500 companies domiciled in 23 developed countries and 23 developing countries, and covers 10 economic sectors. As a result, we watch closely how the key component countries' economies are evolving. However, it is also important to remember that many of those companies have a global perspective, so we also need to keep in mind that it is the companies that we are investing in, not necessarily the countries. Now, our benchmark equity index was higher on the week, as I said, pushing up the year-to-date and one-year total returns to 524 and 765 respectively. The 3-year return is at 432 and the 5-year return at 9, just a little over 9.25. Well, if you combine the equity and bond indices into a balanced scenario and allow for fees and MER costs, the total return for a 60% equity and 40% bond index combination year-to-date is a little over 3.75%. The 1 year, just a little over 5%. 3 years at just 360-ish. 5 years, about almost 6%. For a less risk-oriented 40% equity, 60% fixed income portfolio, the year-to-date number is about 3.5. The 1 year number of 438. The 3-year number just a little under 4%, and the 5-year number just a little under 5%. By comparison, a client who started with us in January has seen a total return this year to date, after fees and costs, of just a little over 6%. Nicely ahead of the benchmark, which is just a little over, as I said, 3.75%. Volatility over the last couple of weeks has eroded the year-to-date performance of the benchmark significantly, but the HIROC client portfolio has remained rather stable because we take significantly less risk in our models and our portfolios while attaining better risk-adjusted returns. The after fees and costs of a 1-year performance of a 60-40 HIROC client is just a little over 5.75, compared to the benchmark performance of just a little over 5%. The 3-year performance, 781, ahead of the 3-year performance, as I said before, of 363. I must also remind all of our listeners that, and I'm sure that you're all very aware of this, but historical returns are in no way a guarantee of future returns, although at HIROC we do work very diligently to try to get the best possible risk-adjusted returns for our clients and ourselves at all times. Well, in fixed income markets, there was little change. The Canadian Preferred Share Index is still the worst performing fixed income market that we track. And last week we showed how the most recent volatility had a minimal impact on Canadian high-yield bonds, and we were using the HIROC Canadian High Yield Bond Fund as a proxy. And I remind all our listeners that we are the managers of this fund in our institutional division, but that is in no way a recommendation to purchase it. Now, a question from a listener last week asked me to explain the difference between the net asset value and the trading price. As this fund does trade on the TSX, buyers and sellers will determine the price on any given day by buying and selling on the exchange at a price that they're comfortable with. Now, the net asset value is the daily value of all the bond holdings of the fund. Now, there's a difference when two sellers are willing to trade out of the fund. When sellers are willing to trade out of the fund at a discounted price to get liquidity. Now, at the moment, that discount is about 4%, but earlier in the year, the discount was wider at about 8.5%. In the world of commodities, natural gas was up and oil was lower, and oil is continuing to struggle to stay in the uptrend channel from its February lows. Now, a breakdown of this may see another test of that $40 level. We'll watch and see how things develop along those lines. Commodity prices are also breaking down through the bottom of their recent uptrend channel. That is not necessarily good economic news. And the Canadian dollar remains in the middle of its recent 70 to 80 cent US dollar range. Well, as I say each week, the U.S. represents more than 20% of the global economy, and with over 50% of the companies in our benchmark index domiciled in the U.S., we do keep a close eye on what is happening in the U.S. economy. Almost 70% of the U.S. economy dependent on the consumer. It is certainly important for the consumer to be confident. Now, when consumers are uncertain, they will postpone spending. Businesses are uncertain, they will postpone investing. This makes it a tough environment for economic growth, which in turn makes it difficult for corporate earnings to grow. Now, the U.S. presidential election is one of those factors causing plenty of uncertainty and will likely cause more as we approach Election Day on Tuesday, November the 8th. For the moment, Clinton has a slight edge over Trump. And it's not just financial markets, but the mainstream economy that also suffers uncertainty. Businesses are reluctant to invest, and historically, 5 of the last 11 recessions have followed elections. And on our recession watch radar screen, and this is something that we have mentioned each week and continue to pay close attention to, is that the 3-year moving average unemployment rate is now converging on the current unemployment rate at a faster pace. Historically, when they intersect, the recession does tend to follow. The U.S. Federal Reserve wants to normalize interest rates. The question that financial markets are asking is, when will this happen? And although there are some who think that they will raise interest rates tomorrow, those odds have been put at about 20%. Now, why is it important? Well, when they raised rates last December, there was a significant amount of volatility that followed in January and February. The U.S. economy is at a vulnerable point, as we've been saying, with the election looming and businesses and households postponing economic decision-making. Further volatility could impact the U.S. economy negatively and add to recession risk. Now, the Federal Reserve has to understand the consequences. As well, the last time the Fed raised interest rates in December, the yield curve flattened by about 60 basis points. Further flattening from the next rate increase, which moves short-term yields up and longer yields down, would also push the U.S. economy closer to recession. And as we pointed out here before, historically, when the Fed raises rates, yield curves flatten and recessions tend to follow. Meanwhile, third quarter GDP estimates continue to decline as the consumer has pulled back on spending. And elsewhere in the global economy, Brexit rhetoric has picked up over the last week, and the pound has dropped below the 130 US level. Last week, the Bank of England kept interest rates and monetary policy steady and also said that a majority of members would support a further rate cut in November if the outlook at that time is consistent with the August inflation report projections. So we'll be watching for the Bank of England in November. In Europe, industrial production declined by 0.5% year over year in July. And as I said, financial markets will be watching the Bank of Japan tonight for an update on their latest monetary policy decisions and how they might try to manipulate the Japanese yield curve. Now in Canada, the latest reading on household debt levels revealed a new record of debt relative to income at $1.68 of debt to each dollar of income that Canadians bring home. Now that leaves Canadians vulnerable to higher interest rates, although it is clear from Governor Paulos's speech today that there will be no change in the bank rate probably for some time to come. In an interesting study, Angus Reid released data on Canadians' expectations on the Canadian economy. Well, Quebec and Eastern Canada are somewhat more optimistic than Ontario and Western Canada. As a whole, more Canadians expect a slightly worsening economy, but it is by a slim margin. Higher debt levels and worsening economic conditions, though, do not necessarily make for a good mix. And in China, China's credit to gross domestic product gap stood at 30%, the highest for the nation in data stretching back to 1995, according to the Basel-based Bank for International Settlements. Readings above 10% signal elevated risks of banking strains, according to the BIS, which released this data on Sunday. Well, where do we see all of this going? We normally turn into the bond markets to see what they're telling us, because they do tend to lead other financial markets. But as I mentioned earlier, bond markets have been in a bit of state of flux as we wait for the U.S. Federal Reserve. The U.S. yield curve was very little changed over the course of the last week, although there was some steepening in the previous week. The Bank of England signaled likely rate cuts for November, and the yield curve there steepened slightly. Pardon me. After a significant steepening following the European Central Bank's decision to not change monetary policy 2 weeks ago, the German yield curve did flatten somewhat last week as bond markets settled down. The Canadian yield curve also flattened slightly. And the Japanese yield curve has also adjusted, but will likely wait and is waiting for the Bank of Japan's next monetary policy decision tonight before it does makes any further moves. So we'll be looking a lot more closely at these yield curves to give us the next clues for the economies, the global economies next week. Well, let's talk about equity markets a bit. So this year alone, earnings growth for the year have been revised from an expected rate of growth of 6% at the beginning of the year to a rate of just below zero at negative 0.2%. Now the S&P stock prices have risen by somewhere just under 5%. And third quarter earnings are expected to continue the negative growth for a sixth consecutive quarter. So why are stock prices so high? Well, two reasons. One, because investors are taking on greater risk as they chase higher potential returns, opting for better yields from dividends than from safer assets. And analysts are actually predicting a rather optimistic 13.4% growth rate in earnings for 2017. Now, analysts had difficulty forecasting 2015 and 2016 earnings growth, so their 2017 forecast may be a little suspect given the outlook for economic growth. Why are earnings important? Because they are the fundamental reason for buying stocks. When investors buy stocks, they buy a stream of future earnings which go to pay dividends or are reinvested in the company. The price to earnings ratio represents one metric to measure stock prices relative to earnings. The 10-year average price to earnings ratio is 14.3 times. The 12-month forward price to earnings ratio, which incorporates those analysts' forecasts for future earnings, is currently at 16.7 times. Now that difference is what makes stocks expensive. That we would prefer, of course, to buy equity assets when they represent reasonable value at or better than the long-term averages. What does it all mean? Well, for over a year now, we have been taking a cautious and defensive posture to investing, but that does not mean that we are not investing. We are utilizing our skills to ensure that our client portfolios are invested to achieve the best possible risk-adjusted returns. It is clear that we've been able to not only capture growth, but keep it in times of higher volatility. Part of the success of our year-to-date returns comes from what we've been able to achieve in our tactical model. Paul, anything to shed light on for this week?
Yeah, just overall, we added a pretty big position. We added a big position in a specific high-yield bond, but we also own other parts of the capital structure, other securities within that same company. Without doubt, that is our biggest position right now. There is a catalyst event that should drive some further returns in all three of those securities. Away from that specific situation within the tactical, we did some profit taking. We did in couple securities. We did a small stop loss in another one, which we may enter into an entire stop loss on and be disciplined. In fixed income, I would just notice as well, Scott, that we a couple weeks ago, I think I wrote a blog on how something changed, but the correlation between the bond market and the stock market right now is very, very high. So government bonds are not behaving the way they used to behave, and they seem to be following stocks. And although yields in some of the charts that you showed earlier have come down for sure, stocks have gone up. So that correlation remains very, very high still, and until we see that break, I'm not going to want to add a whole bunch of interest rate risk or government bond risk right now. So we are... Go ahead.
Sorry, and I guess that makes sense in light of the fact that we're going to see the Bank of Japan let us know this evening about their latest monetary policy decisions, as well as the U.S. Federal Reserve, and I think tomorrow, and I think that a lot of market participants have been paring back positions as well by virtue of the uncertainties of some of these central bank moves.
Yeah,
interestingly.
So we'll wait and see how those play out, but certainly observing the market right now and looking at correlations between government bonds and stocks. That's it.
Okay. Thank you. And let's look and see what's on our radar screen coming up. As I've mentioned numerous times already, we've got the Bank of Japan and the U.S. Federal Reserve making their interest rate decisions tonight and tomorrow. We've got some data coming on Thursday from the European Union, consumer confidence. We see some home sales data from the U.S. also, Canadian inflation on Friday, and then new home sales for the U.S. on next Monday. Then, of course, on Tuesday, our HIROC webinar. On Wednesday, we'll see U.S. durable goods, which will give us another bit of a signal on the consumer in the U.S., and then a whole slew of data for next or Thursday. It should be Thursday, September 29th, not 22nd. My apologies on that. Once again, all our clients should have received an invitation to our October 5th event. This is an event that is not, and I repeat this because it's not a sales pitch by any stretch. It is a client appreciation event. Although we do welcome our clients to bring guests, I think you'll enjoy Tim Faulconer, who is a wonderful writer and a great speaker, and you'll also enjoy the music of Tyler Ellis, one of Canada's premier folk artists. So please, if you haven't responded, we would love you to, and we'd love to see you on Wednesday, October the 5th. And that's it for today's discussion. If anybody has a question, this is your time. Okay, we've answered everybody's questions, and anybody who is listening to the recorded version, if you do have a question, I really do enjoy getting them. We also appreciate all the feedback that we do get on these calls because it helps us to mold these calls into what people want to see and hear about. As always, thanks for taking the time out of your busy schedules to tune in. Don't forget to tune back in next Tuesday. But until then, this is Scott Thompson signing off.